Good afternoon. This is Clark Neighbors with BIS Commodities from Cedar Rapids, Iowa on this beautiful Friday with a grain commentary, livestock, and commodity commentary for the week ending September 25th. Since we're towards the end of the month, let's focus on where the market has transpired this last 25 days, I guess. December corn is down about 40 cents for the month of September. November beans down around $1.10. Wheat, December wheat down 90 cents. Keep in mind we've seen the dollar index during the month up almost 3 points and a little lower in the stock market. Now keep in mind the break in the beans versus the corn to some degree is probably overdue based on the ratio. And current ratio, historically speaking, on corn at 2.4 to 1. If you left December corn unchanged and took it times that ratio at 2.4, I tell you beans are still potentially $1 overpriced in comparison to the historical ratio. So keep that in mind. It's not to say that ratio's got to correct itself in the next month or 2 months, but I think there's something going down the road because of the fundamental issues, the big crop here in the U.S., potential big crop in South America, and so on as we go down the road. The other thing that I wanted to touch on is the seasonality of corn in two specific years. I'm going to date back 10 years ago and 20 years ago to 2004 and 1994. Now those two particular years were record crops and a big percentage above normal trend line, similar to what looks to be transpiring this year in 2014. Market direction or direction of the charts were real similar to those years. In other words, in May, June, and July, the market broke pretty hard, and you stabilized in the month of August, almost stating that the market was saying, prove to us the yields there. And once you got into September, as the combine started to roll, and obviously into October, the market then started to make new lows and slowly ground lower. In those two particular years, the lows in the corn market really didn't come till the winter months, December, January, February. So I think that's something to keep in mind just from a historical perspective, looking at those 2 years. Unless something changes dramatically on the demand side, seeing a quick bounce in this market in the next few months looks a little unlikely at this time. Next week we get a stocks report, USDA stocks and all position report. Typically that report has some impact on the market over the last several years. This year maybe not as much because of A, the big crop, and B, the tightness of the stocks. We should have a pretty good feel where we're at. What the trade guess is looking for on the stocks, though, corn 1.185 billion bushel, 126 million on the beans, and wheat 1.88 billion bushel. It's an interesting article in the Wall Street Journal this morning in relation to commodities and talking about hedge funds and investment banks, index funds, etc., and their tendency to move away here recently from your typical commodities, the energies, the grains, some of those, and to look at other commodities that are tight in supply in the world marketplace. Three in particular: coffee, cocoa, and cattle. Anyone of our customers that follow the cattle market, we've talked about the severe volatility in the cattle market over the last few months. Today is a good example. Front end of cattle, October, December cattle up the limit, $3 limit today. I believe for the month of September, cattle are up about $7. The difference between the current rally and the tight rally from supply that we saw most of this year to date this is a future-led rally versus a cash-led rally. Up till the end of August, cash was a premium over futures. Now we've reversed that. Be interesting to see how that plays out. The other kind of topic in the livestock hogs report came out this afternoon. All hogs at 97.7. Trade was looking for 96.7. So a few more hogs inventory than expected. Maybe the PED situation hasn't been as tough. Breeding herd at 101.8. Marketing's at 97.3. Livestock market has had not only the cattle but the hogs have had a lot of volatility. So be aware of that volatility and use risk management wisely in those markets. Going forward, 2-3 things to watch the next week. One was the stocks report, as I mentioned, and then obviously harvest progress. Weather looks pretty good till the middle of next week. In some areas we're seeing pretty good harvest activity, central Illinois, parts of Missouri, but you get north of Interstate 80, especially in Illinois and so on, and in Iowa. Activity's been pretty limited at this time, but that progress should pick up over the next couple weeks depending on weather. So watch harvest progress. Yield reports have been fabulous in a lot of areas. That storyline, we'll see if that continues, but obviously there's whispers now of the national yield getting bigger again. I mean, the trades looking for something north of 175 and some even whispering a 180 nationwide in corn. Bean yields, which have been nothing short of fantastic in most areas, talking upper 40s, so we'll see how that all plays out, but obviously the market's taking some of those factors into account. The other thing is watch as we go into harvest is transportation issues, logistical issues, localized areas of tight space. As harvest progresses, that will be interesting to watch how that transpires. Now, the transportation sector has taken that into account in many ways. Rail costs are at or near all-time highs as far as the movement of grain in the Midwest or out of the plains. Barge freight, transportation on the river is at 1,000%. We've only seen this one other time, and it was for a short amount of time during Hurricane Katrina, which would have been 9 years ago. Just to give you an idea, roughly $1.50 a bushel to move bushels from the general part of the Midwest to the Gulf of Mexico right now. So that increased transportation cost is having some impact potentially on our exports as we try to be competitive in the overseas market. A lot of this transportation issue is coming from the tough winter last year, railroads being backed up, and also the explosion of the crude or the energy market in the Dakotas, more specifically North Dakota. Keep in mind, 7 years ago there was 0 crude trains leaving North Dakota. Now on a daily basis we're seeing about 9 to 10 crude trains going out of North Dakota on a daily basis, and estimated in 3 years that could be up to 18 trains, shuttle trains, moving crude products. So the transportation story is going to be interesting to follow. Again, harvest progress, logistics, transportation, and a grinding market in the grains. It seems like it will continue to grind. Stay tuned. It's been Clark Neighbors with BIS Commodities in Cedar Rapids, Iowa. If you have any questions, feel free to call us at the office. Phone number is 800-373-2525 or biscommodities.com. With that, have a great weekend.